Everyone is worried about interest rates, tariffs, geopolitical chaos, but those are not the biggest risks to the stock market in 2025. The real threat, valuations. Stocks are selling for prices that make absolutely no sense. And history shows when you overpay, your returns will suffer. Peter Lynch always said there's a 100% correlation in the long run between a company's stock price and their future earnings, as long as you pay a reasonable price. You wouldn't pay $400,000 for a $250,000 house, would you? So why are investors doing that? In fact, it's even worse. Investors are blindly paying 2 times more than what companies historically have sold for in total. In this video, I'm going to show you why valuations are flashing red and what that means for the next decade of your portfolio. This is not to make you scared and sell everything. Quite the opposite. It's to be prepared and look at every future crash or bear market as your opportunity. Do not go out there selling in mass. That's not going to work out well, because you're eventually, even if you get it right this time, you will cost yourself in the long run. Guys, headlines change. Go look at go Google the biggest headlines of 2022 and tell me what anything relates to 2025. They're all different. But when you're in the moment, and you're seeing these headlines and you're getting fearful, you're getting scared, you're getting all these things to happen. We've always said that markets are going to crash or have bear markets, and we're going to sit there and see it's because of this, and it's going to be some headline that we see, and it becomes a big issue. And then sure enough, 18 months later, it will be a non-issue, maybe even faster than that. Guys, this is my stock market to GDP ratio, the Warren Buffett indicator. He says it's the most reliable metric at any given time. Now, it makes sense. As the GDP of the US gets bigger and bigger, the companies within that GDP should get bigger and bigger with it. Now, I know there's gonna be comments, oh, Paul, but GDP doesn't get everything that all companies make internationally. Shut the fuck up. Just stop with that BS. You're just looking for reasons as to why you're trying to justify higher valuations. Just like if we have markets crash, there's going to be all the reasons why the information says that the crash isn't over. That's called human nature. But right now, we currently stand at 100.43% overvalued. The historical average means that we're 100% over that. Now, the last big bubble we had in stocks was 2000. So let's go all the way back to 2000 here. Guys, look at this. 50% overvaluation. We are double the overvaluation that we were here. And you know what this crazy part is? The next 10 years, these are the returns. Negative returns, okay? Doesn't include dividends. So with dividends, it was still negative because dividends weren't 2.6%. Now, let's go to when valuations were low. 1982, we were 65% undervalued. Look at returns for the next decade there. 12, 13, 14%. The more you pay for something, the worse your returns are going to be. The less you pay, the better you're going to do. Guys, this is an iPhone. This iPhone is worth $1,000, give or take. If you paid $2,000 for this, how's your return going to be? 5 years from now, how's your return going to be? Pretty terrible, right? It's worth $1,000. If you pay $200 for it, $300 for it, $400 for it, how much are you going to make? You're going to make a crap ton. The current market right now, if this thing is worth $1,000, the current stock market has this selling for $2,000. The 1982 stock market had this thing selling for $350. What would you rather pay for $1,000? If I handed you a $1,000 bill today, would you want to pay me $2,000 for it or $350 for it? It sounds pretty easy, right? Of course it's not. We don't know the future. We have no idea what's going to happen. Is there a world in which today's stock prices are normal? Yes. But what does that world have to be? Well, if GDP goes up, stocks go up with it. So how much does GDP have to rise above normal to make today's valuations look okay? 8, 9, 10% a year for the next 10 years? Let me ask you a question. When was the last time we did 8, 9, 10% a year for 10 years? Spoiler alert, I don't think it's ever happened. That's what's incredible in our recent history. So why do you want to overpay for a stock? You'd make fun of somebody who paid $2,000. Why'd you pay $2,000 for this? You're an idiot. Yet with stocks, we revere people who are buying stocks. Now, this overvaluation is a warning. And it's a way of saying, hang on a second, just be ready. Be ready for a sideways market for a long time. And guys, I just brought up 2 examples, but this goes all the way back in time. In fact, if you look at it, the correlation between valuations and future 10-year returns is negative 0.8. This means that the higher your valuations, the lower your returns is. Guys, if you're a statistician out there or know somebody, that's an extremely strong inverse correlation. This is very, very strong. It goes from -1 to 1, with 0 being no correlation, -1 being a perfect inverse, 1 being a perfect direct correlation. I'm getting a little too mathematical here for a lot of people, but the bottom line is you should not sleep on this. Don't look at this and think to yourself, well, it'll be different this time. Because that's what you're saying when you say, I should buy stocks and stocks are okay right now. Now, if you agree with me that stocks are overvalued, does that mean you stop buying? No. And here's why. We're sitting here, guys, and stocks have been overvalued for a while. Look at these overvaluation numbers. We've been overvalued for quite some time here. I mean, look at this. 2021, we were 95% overvalued, but fair value was 2,100. Now fair value is 2,800. Stocks were at 4,100. They're now at 5,600 on the S&P. We don't know when the correction will happen. Your job is to be systematic about it. Take all the emotion out of it. I want you to understand where we are with valuations because in the future, if stocks go nowhere, I want you to be like, well, yeah, of course they went nowhere. Look at valuations. But as values go like this, prices go like this. We're probably somewhere in here right now. We will eventually be somewhere in here. It's important to understand this so you understand this. That way, when you're doing this all along the way, when you're here, you're like, yeah, but it'll work itself out. We'll be good. That's why it's important to do this. Now, if you're close to retirement, you should be a little concerned. Now, I'm not going to tell you what you should buy or not buy. It's about understanding your goals. The question I have to you is, would you rather protect downside risk or get a few more percentage points on the high side? I don't know if it's going to work out or not. But if you're under the age of 40, you shouldn't be worried about this. You should just systematically buy month in, month out, whatever you're doing, every week, every month, every quarter, every year. I don't care. Don't stop doing that. I have grandkids. I put a little bit of money away for them every single month. You know what I tell their parents? Buy the S&P. I don't care where it's at. That's all I tell them to do. It's really important to do that. In the short run, stocks are a voting machine. In the long run, they're a weighing machine. What's popular in the short run is going to go up. What's not popular is going to go down. In fact, look at this, guys. Let's pull up QQQ, the NASDAQ ETF. Guys, in the last month, it's up 12.76%. In 1 year, it's up 14%. So basically 90% of that gain is in the last 1 month. We don't know what's going to happen, but I do know that in the long run, if you pay a reasonable price for a company or the stock market, you will do quite well. But you know what's interesting? I say this in a lot of videos. That same QQQ fell 80% from the peak in March of 2000 to August of 2002. But if you started buying at the peak and dollar cost average all the way down, you've made over a 14% annualized return on your money. Buying starting at the peak, watching your money fall 80%. That's how important dollar cost averaging is. If you're trying to time getting in and out, you're probably going to do poorly. Even if you get it right this time, it's going to hurt you in the long run. Now, why do most investors ignore valuation? Because we're excited. We see our stocks going up. We sit there and go, oh, I'm getting richer and richer. We feel richer. It's hard to go against that. It's hard to see your friends make money and you're not. I'm one of the few people that's quite all right with that. You know why? I have a certain goal for the future. And as long as I did the math this morning, as long as I make 3.3% of my money for the rest of time, I am never going, I can quadruple my spending and still be fine. My situation is different than everybody else's. But you've got to stay in the market because you got to get in the habit of buying every single month. Because when things are bad, when things look bad and feel bad, that's the best time to buy. Guys, this is the chart of the S&P going back to 1950. I always say this. If I told you that you could only buy 6 times in history, when would you have bought? You'd have bought here, 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 here. I mean, I'm just sitting here going examples. My point of all this is this. The stories were the worst. The future looked the most bleak. That's what's hard about investing. These all look like opportunities. But when you're going forward, as Morgan Housel says, it feels like a risk. You got to change that thinking. That's why this channel is very important to people. You got to change the thinking. It's not about sitting there. It's about preparing yourself. Real financial metrics are what drive long-term value. The short run is driven by that voting machine. The long run is driven by earnings, cash flow, all these things that accrue over time and get better over time. This is not some voodoo science. It's an art. But history tells us what the future is probably going to look like. Could that future be wrong? Sure, but what has to happen for that future to be wrong? Is it likely? We're not coming off the 1980s and 1970s with stagflation, where we had high inflation and low growth. That's where the spring of the entire market and the economy was getting ready for the 80s. And then the 80s and 90s, we just absolutely catapulted out of nowhere. So how do principle-driven investors like us, like you, navigate overvalued markets? Well, when it comes to ETFs, we just continue on with our process. I truly believe that you sit there and you buy individual ETFs and you sit there and do that systematically nonstop. With the portion of your money that you want to buy individual stocks, you've got to approach it principle-driven style. You got to sit there and say, okay, can I pay a reasonable price for this company today, knowing what the future holds or could hold? That's why we have the stock analyzer tool here. You'd sit there and you put a company like Nike in, and you make your assumptions about the future, and the stock analyzer tool on low, middle, high assumptions will say to you, hey, if it's around this price, you should do okay. Does that mean you go buy it immediately? No, but it's a good starting point. I always tell people, I start my stock analysis with stock analyzer tool and I end it with stock analyzer tool. In the middle, I'm looking at the data that says, hey, what has to happen in Nike? What does the future have to look like for me to make a good buck? Well, guess what? The lower Nike stock goes, the less I have to care about what happens in the future. It's the more margin of safety. But the interesting part is Nike's at 62. When it was 180, we were like, we're a little apprehensive about this. We want to wait till it goes below 100 before we evaluate it. And people were like, you're an idiot. You don't get it. And there's countless examples like that. We're at 62 bucks, 65% lower. That's the mentality I want you to have. Don't fear the market. Fear overpaying for it and not being ready for what's going to happen in the future. It's okay to overpay for things if you have a systematic process that is done month in and month out. Now, guys, the Magnificent Seven has absolutely crushed it in the last few years. I went so far, though, as to create my own personal Magnificent Seven to follow the original ones for years to come. Because I want to prove a few things. One, that boring will outperform hype in the long run. And two, that there'll be a time in the future and you guys are like, who cares about Magnificent Seven? Just like we used to have FANG. No one cares about FANG anymore. It'll just show how much we move on from idea to idea. So if you want to see my video where I show you my personal Magnificent Seven, please watch this next one. I assure you're going to love it. Thank you for your time.